So today I'm doing the UK stocks I'm buying April 2024 edition. This is where I go through all the UK stocks that I bought or sold from the 1st of March to the 1st of April. So I've done this series on the channel for a long time and it just keeps up that transparency so you guys know every move that I've made in the stock market. This is very different from what other YouTubers will do. They will potentially buy something and not tell you about it, then all of a sudden they're up 100% or something on the stock, or potentially they'll buy something and then they'll never tell you that they sold it and they sold it out at a loss and it never worked out. On this YouTube channel, if it works out, I tell you. If it doesn't work out, I'll tell you that as well. And like I said, I'll go through all the moves that I made in the UK stock portfolio from the 1st of March to the 1st of April, as we do every month. So I hope you enjoy it. Let's get started. Now, if you do want to know when I'm buying and selling companies in real time, the place to be is on the Patreon. Already this month, I'm not going to lie, I have sold 2 stocks and brought 2 new stocks into the portfolio. So you'll have to wait until the end of the month on YouTube to find out which stocks they are. But if you want real-time updates, the place to be is on the Patreon. You support the channel for all this free information I give you guys, and as well as that, I give you 2 exclusive videos a week, a Discord with 500 members on to talk about stocks, including me, and it's all for £5 a month. The price of a pint, unless you go to Wetherspoons up north, then it might be less than that, but it's not too bad at all. And if you want some free shares from Trading 212, personally for me, that's the broker I use. I think that is the best broker out there, and that's where I personally put most of my money as well. Join through the link in the description. You can get a free share worth up to £100. And the first one on the list is JD Sports. Now, I did buy JD Sports before it did have this bump up in the share price. It brought out some mega results, so just going to warn you of that. But saying that, I think I did make at least 2 videos on this stock saying that when it was at these levels, I can't believe how low it is. I gave you a couple of hints that I was buying at these sort of levels. So yeah, I did buy during this period of time. It has jumped up a little bit at the moment, and I think if I were to buy a little bit more JD Sports, it would probably have to fall down another 5-10%, which it can do. It's been falling quite a bit because of the likes of Foot Locker and Nike bringing out poor results. But JD Sports has been breaking the trend and bringing out good results. And it's been a bit frustrating to see JD Sports being suffering a little bit on the share price because of the poor results of Nike and Foot Locker, when their results have been pretty impressive. Now, JD Sports, I'm sure you've seen a lot of stores on the high street. They've got a lot of stores as well around the world, in Europe, in US, the online presence as well. And even though they don't own their own brands, they sell a lot of other brands. And a few people might say there's not much of a moat there, but if you ever go onto the high street and you ever go into JD Sports, that is the place to be. This is a popular place at the moment. I went to Meadowhall, I think it was last week, and we went into Meadowhall, and there was a lot of shops there, obviously, and imagine shops in Meadowhall. But we went in there, and the busiest shop in the whole shopping centre was JD Sports. It was heaving. All the other shops were okay, but everyone was going to JD Sports, and all the younger people were going to JD Sports. So the likes of Nike and Adidas, they have to sell through JD Sports, otherwise they're going to lose out on a lot of service. You know, Nike might try to go a little bit direct to consumer, might try to take it away from Foot Locker. They're not taking it away from JD Sports because it is the popular brand to go to. And that was in the results as well. You look at the recent results, the last results were very impressive, especially when you look at the numbers that Nike are doing and the likes of Foot Locker are doing. And they're saying we're seeing such a weak environment. Lululemon as well. And JD Sports come out and go, yeah, it's been a little bit challenging than normal, but we're still doing okay on the results. You know, this is so impressive in this time period. Imagine if we start seeing the improving time period as well. And as long as they keep expanding into the US, that's where they're going for, the big expansion into the US. If they keep opening up more and more stores, they're opening up another 500, 600 stores in the next 5 years in its US market, then obviously when we see a rebound, that's going to do very well. And like I said, this is just during a period where Nike's having poor earnings and they keep absolutely smashing it. So that's what we want to see. You're picking this company up at 10 times forward earnings. Now, last time I did talk about JD Sports, it was, I think, 8 times or 9 times forward earnings. So it has gone up a little bit because of the share price jump. But realistically, if I wasn't in JD Sports, I mean, 10 times forward earnings isn't that bad at all. Especially when you're considering, when you look at the share price, for example, it's still pretty much below its 2020 levels. And yet you look at the financials, for example, and if you go on the past performance to 2020, The company was doing 6.1 billion in revenue. It's now doing 10.4 billion. It's nearly doubled. From a profitability point of view, 246 million. Now it's about the same on the profitability, but there's a couple of charges in there. So if you actually take the charges out, that's about to jump up to 602 million in profitability, which is very good for a 6.5 billion market cap. That's why actually, if you look on Google at the moment, the P ratio is 33 because it doesn't actually account for the full level of profitability that they've actually just put in. That's why actually realistically JD Sports is actually at 10 times earnings. That's why you always look at forward metrics as well, guys. But yeah, for a company at 6 billion doing 600 million in revenue is pretty impressive and should carry on growing at really good levels as well. You know, this company should be trading more towards 20 times earnings at least. This is a very good growth, very good UK company, and should be trading at more of a premium at the moment. So yeah, bit of a surprise there. And obviously good financial health. It sits on 4.6% debt to equity, so not much at all there. And you know, with 600 million in cash, I mean, it could pay all its debt off quite easy. It's going to potentially have a lot of room to do share buybacks, which I think it should be doing at these sort of levels. A dividend, we could see the dividend hiked up. I mean, it already pays a small dividend, but there's room for that to get hiked up. So yeah, I mean, there's going to be a lot of options on the balance sheet because it's going to throw off that much profitability as well. I mean, already it sits on 1.4 billion, so it's got nearly 20% of its market cap in cash, so it's looking pretty impressive. And that's probably why a couple of insiders have been buying up the shares as well. You know, the CEO bought some shares. You can see here the chairman of the board, 18th of January, £1.09 bought some shares, so a little bit lower than where it is right now, but nothing too crazy, and that was 148k buy as well, which is a pretty decent size for a UK business. So yeah, there's a lot to like here. I've been pointing this one out for a while. Next one was Darktrace. So I think I did buy some Darktrace at the start of March, so that was obviously before the jump in share price, and I also think I bought some during this period here. So only about 2 weeks ago that I bought some Darktrace. Had a little bit of a dip on the share price. Somebody was selling some shares, and once again, Darktrace, I've talked about this for Darktrace for a long time, like it just has these crazy dips out of nowhere. Like there's news that isn't even that significant or that much of an issue, and then the stock just drops 10%. It's like JD Sports. JD Sports posts amazing financials and yet it drops because Nike flopped. Darktrace does the same. Like another company in the cybersecurity network brings out poor results and Darktrace gets stung with it. And it's like, why? Because they've just like upgraded their guidance only 2 weeks ago, and yet we're dropping on it. It's crazy. So it keeps gifting you with opportunities to buy. When them do happen, I keep buying up the shares. So even though for me, I mean, I've been owning Darktrace now for around about just over a year-ish. I started buying in the low £2 range, and since I did start buying Darktrace, you know, the stock is up a lot. I'm up about 40% because I keep averaging up on it, and I don't mind averaging up on it because I still don't think it's like a terrible valuation here. 33 times earnings. Darktrace itself is a cybersecurity platform that learns and improves by itself and offers these products, which is prevent, detect, respond, and heal. And even though a lot of companies have been more cautious around the spending, Darktrace has been pulling out fantastic numbers. The market itself, cybersecurity, I'm sure you've seen it all the time, especially with the demand of AI. I think cybersecurity is only going to grow because of this situation. And also, I'm sure you've seen it now, there's just so many cyber attacks going on here at the moment. And when you're a cybersecurity company, they're going to have a lot of growth, in my opinion, going forward. Trading as well at like forward times of 7 times earnings. Revenue is growing absolutely insane. 20+ percent growth a year, good amounts of profitability, nearly 90% gross margins, absolute cracking balance sheet. There's no debt on there, and obviously they're going to be throwing off a lot of cash at the moment, so they're going to have a lot of options what they do with the cash, maybe through a share buyback. I think they should be doing a little bit of a share buyback. That would be absolutely amazing. So yeah, I like Darktrace. I think that we don't have that many good tech companies in the UK, and we finally got one here, and I think it's mega undervalued here. So I think this was on, I think a lot of their revenue now comes from the US, and I think if they were to move to the US market, I think this company would be probably double where it is right now, which is crazy to say. So yeah, I think in the long term I would like to see Darktrace move to the US market, but while it's still here, it looks a pretty decent value because any sort of these cybersecurity companies on the US market, they trade at like 90, 100 times earnings, which is absolutely crazy. And the fact that this is going to be around about 8 times, 7 times forward earnings right now for 20+% growth, yeah, it's good. Card Factory. So Card Factory is a funny one because we talk about this a lot on the Discord. So when you join the Patreon, you get access to the Discord, and we talk a lot about stocks here. And Card Factory's talked about a lot on the Discord because it's a funny one because it stagnates for a while and then it just has these jumps in the share price, like 100% jump, and then it stagnates for a while during this period of time. You can see it down more than stagnated, it fell down quite a bit, and then it jumped in share price, and then we've had the same thing where it's kind of stagnated again for like the last year, especially with how much the market's rallied a lot recently as well, and it just seems like it has a long period of stagnation and then it has a big jump. And I think a few people are kind of at the point where, I remember this during this period of time, a few people were kind of like, oh, it's not done anything, like people getting frustrated because it's not really done anything. But I think patience is key here. I think if the company keeps delivering on the financials, it will get rewarded. And with Card Factory stagnating for a long time, like I've been up on this position for a lot. Like I could be up over 100%, but I keep averaging up more and more because I look at the financials and I go, eventually the share price is going to move in line with the financials, because this company at 6 times earnings, it shouldn't be there. This has been a fantastic performing company in the last kind of 4 years, since the CV situation happened and they were more forced to work on partnerships, online expansion, cutting costs, not paying a crazy dividend, getting a new CEO in. The company has really turned around now and it's really firing on all cylinders. And also, when you look at the competition now, you know, look at the facts like a Moonpig. No one right now wants to go pay £4 a card to send it on Moonpig. You go to Card Factory, there's nearly one on every high street. You go pick up your cards there for 99p or whatever it is. That's what everybody wants. So the economic environments as well helping them massively. And everyone likes going to Card Factory for the cards because it saves so much more money. The new CEO that came in, Darcy Wilson, has done a cracking job as well. He's focused on the partnerships as well, so they've got the stores, they've started selling through the likes of Matalan, for example, moving international as well. Obviously, there's no big overheads for them because they're not actually paying for the stores, and they basically just send the cards out and they'll pay them cards. So this is a great profit expansion for them where they don't have to take that much cost on as well. And yeah, I mean, you look at the company now and it's starting to get back to the old levels that it were doing before the whole CV situation. You know, revenue's getting higher above it, the profitability is starting to get higher than that time, but yet the share price is nowhere near where it used to be. It's nearly half of where it used to be. And the thing is about now is that it's improved so much financially. They've cleaned up the balance sheet because they haven't been forced to pay a crazy dividend out. So if you look here, the company used to sit around 86% debt to equity. It's now down to 34%. They've reduced the debt by half, which is obviously really good. The cash balance as well has improved because they're not being forced to pay that dividend out. So you can see here, they were basically very close to bankruptcy, really. 4 or 5 million in cash. They're now set on 28 million of cash, and obviously as well, they're very close to finishing another year, and that cash is going to jump up a lot. Once again, if they generate around 47 million in cash, and you look at the debt here, they're going to pay off a good amount once again. I actually think the debt is lower than where it is on Simple Wall Street. I think, as you can see here, this is July the 1st, 2023. I think the debt has actually gone down to the 70 million mark now as well, so it's even lower now, actually, to be fair. Dividend wise, like I said, they used to pay a dividend. Obviously, if they paid the dividend what they used to pay, that would be around about 12% dividend yield right now. So I don't think they'll go back to the old levels because that's what killed them off originally. But I do expect them to start paying a dividend this year, which I think will probably be around a 3% yield as well. Ownership wise, insider buying as well. Darcy Wilson did buy some shares at 91p a little bit while ago now, last year, but still quite recent and good to see. It's only 4 pence above where he bought as well, 6 times earnings. So I mean, it's a Card Factory. It's not a major change of the world business here, but for 6 times earnings, I think it's business that if that dividend comes back as well, I think you should be talking about Card Factory trading around 13, 14 times earnings. So yeah, I do like Card Factory from these levels where it is right now. Next one's Money Supermarket. So Money Supermarket has actually stitched me right up, because I've been building a position in this for the last kind of year. And for the last year, I've had to average up, and I've gone, I really want the stock to go back down. It was back up £2.70, £2.60. And I was like, I really want the stock to go back to £2. And I've been averaging up, and I finally kind of got a position built out. And then in the last 2 months, the stock's decided to fall 20%. And I'm like, you buggers, like, I've been waiting for you to drop. Now I built up the full position up. Now you drop. How annoying is that? So, I mean, I'm only down like 10% on the position, but I would have loved to buy this at £2.20p a few months ago, rather than buying at £2.50, £2.60 where I was starting to buy at. So yeah, I do like Money Supermarket at these levels. I got to say, if it could fall that a little bit more, if it could go just below the £2 range, that would be really good, because you'd be picking this up at then like 14 times earnings. I think that's really good, because this company should be around 20 times earnings. Your dividend yield will be going up a lot more as well. You'd be talking about a 6% dividend yield alone. So that's going to be really nice to collect. So if it can go a little bit lower, that'd be absolutely amazing. But I do really like this business at the moment, because I think it's a high quality business. Obviously, Money Supermarket, they do comparisons. Obviously, people are trying to save money, especially with how much like insurances are going up at the moment. If the energy situation comes back as well, that's a big driver for this business. This was a big contributor to revenue and profit that they've not had really for the last kind of 3 years. So once that comes back, that's going to be a real big driver for this business to grow that revenue and profitability. And if you actually look at the current numbers that they are doing at the moment, the profit is getting close to where they were before the whole CV situation, and the revenue is obviously higher than where it was. So you imagine as well, once this energy comparison starts coming back and you add that on top on profitability, the company's easily going to be pushing up to about 100 billion a year. The revenue is going to be quite high as well. Profit margin is going to expand, because obviously it's not going to cost them that much to add in the energy market. It's all there waiting to go. So your profit margin is going to expand as well, which will be really nice to see. Good valuation, like I said, good dividend. Obviously they throw good amounts of profitability as well, and they've got a cracking balance sheet with that. You can see here they sit on around about 15% debt, so I could say they can pay that debt off very easy. Cash balance wise, they do sit on 16 million of cash as well, but obviously they're generating 72 million of profitability a year. That's going to lead to more dividends or more share backs. So even if it doesn't get to that 6% dividend yield by a share price drop, you'll get it hiked up there eventually, buying at these levels. We'd like a few insiders to come up and buy some shares. That'd be really nice if that could happen. But yeah, I like Money Supermarket at these sort of levels, and if you can drop another 20%, that'd be absolutely amazing anyway. And the last stock is Barratt Developments. So I keep thinking about how large I want to make Barratt Developments. I really like the UK house builder sector at the moment, and I think that we are there. I think we are at the bottom of the UK housing market now, and I think all you'll see in the next few weeks, months, is the rebounding the UK housing market. I think everyone has adapted to the interest rates about right now, and if anything, what we're going to have the interest rates start getting cut. I think the UK will jump before the US for a change in the interest rates. I would expect the first cut in the interest rates to start coming in a couple of months' time in the UK. We don't have a good economy like the US, and we want to be starting to get it kick-started a little bit. So I think we will see the jump, and then as soon as that first jump comes in, I think we'll start seeing everyone taking advantage of that, because what you've had in the last year and a half is people that have been like, oh, I really want to buy. Obviously, we've already got a shortage of houses in the UK. But there's also been a few people that have been put off with the higher interest rate environment. They've probably been sat around for like the last year and a half going, oh, let's just wait until the interest rate starts cooling down. So as the interest rate starts cooling down, there's going to be like the demand for houses, everyone that's kind of been waiting for houses, and also people that have been wanting to move and been saving up waiting for the interest rate. I think we're going to see a really hot housing market in the next 2 years. And I think as well, just because of the supply issues in the UK, we're going to do really well from holding a UK house builder. But Barratt is having a little bit of a slump at the moment because of its big acquisition of Redrow, which the market doesn't like big acquisitions like that. But if they do the cost savings that they say they're going to do by buying Redrow, we're just going to see this go really ballistic as well on the profitability side of it. Share price wise, it's sitting about a low of what it has done for the last few years, apart from obviously the big crash in the 08 situation. But with this business, I think you'll see a company that even right now is still making decent profitability in this high interest rate environment at the moment. So you imagine as soon as those interest rates start cut, they're going to throw off good amounts of profitability. Growth will start coming back. They've got a decent balance sheet as well to manage the whole situation. There's no really debt on, well, I guess there's 200 million of debt on there, but they sit on nearly 1 billion of cash, which is very, very nice amounts, as you can see, and then 25% of the balance sheet. So they could still afford to keep paying a bit of a dividend out during that time frame, and if the environment doesn't improve for maybe a year longer, then they'll still be okay. And as well as that, you're going to collect a really nice dividend, and as the housing market improves, we should see that go up to more of a 7-8% dividend yield as well, which would be really nice. And there has been a couple of insiders, they've just actually gone off actually. There was a few insiders buying around about 12 months ago as well inside the business, which is about the current share price where where it is right now. So that's obviously something that you want to see when you are looking to buy a business as well. So yeah, that was the last stock on the list. So I hope you enjoyed the video, and those are the stocks that I've been buying through the 1st of March to the 1st of April. There's been nothing I have sold during that period of time, but those are the 5 moves that I have made during that time period. So I hope you enjoyed the video. Let me know in the comment section any UK stocks that you've been buying. I always like seeing some of your picks as well. And yeah, I'll see you all in a bit.